Good morning, ladies and gentlemen. This is Butch Sharak. It's Friday, June 22nd, 2012. Access to this webinar or video is for educational and informational purposes only. Nothing contained in this video, website, or promotional material constitutes a promotional recommendation, solicitation, or offer of any particular investment security or transaction. Options University provides educational services that are meant to teach you the risks and rewards of trading stocks and options, and we're not a service that tells you what to trade. We're not implying or guaranteeing any profits, and the concept trades which we show you are those to give you the concept of what it is that we're trying to teach and to enable you to go to your own charts and make decisions based upon good solid knowledge of entrances, exits, targets, and those things which will make you a profitable trader. With that, let's go ahead and take a look at the economic data that took place this week, as we had a huge week in the market. Aggressive broad-based selling on Thursday after some very, very interesting economic announcements actually shoved the market down. During this week, we had the FOMC meeting, which started on Tuesday morning, and then we got our announcement on Tuesday afternoon at 2 o'clock when Mr. Bernanke told us that there definitely seems to be more weakness in our economy than was previously expected, and the Fed was going to continue on with its Operation Twist, which, whatever that means that things aren't looking as good as they would like them to be. Thursday morning, we saw jobless claims come out. They came out at 8:30. They actually were a surprise to the upside, much better than what we expected, and that there were fewer unemployment compensation filings made in the last week than what was expected. So that was good news. And then we had some issues. PMI, the Philly Fed survey, actually came out quite disappointing, as the PMI manufacturing was 52.9. It's the worst reading that we've had in 11 months. The Philly Fed survey fell unexpectedly to minus 16.6 for June, registering its worst reading since August. So not exactly great economic announcements that came out. And when we saw those come out, we saw that the market plunged and continued to plunge through the rest of the day, closing very near its low for the day. Interesting in that there wasn't much of a bounce, and we gave back everything that we had gained during the previous days of the market. As we were in an up cycle, in a sideways trend, as we're spending time above and below the moving average, we've now switched from a downtrend to a sideways trend. Now the question is, what's the next trend? Well, if we're in a sideways trend, our next trend is either going to be an uptrend or a downtrend. And now it's just up to us to interpret when that takes place. At the moment, we are in a sideways trend, and we are in a down cycle because on Thursday we got a lower high and a lower low, and we call that one big candlestick on Thursday. So quite a move out of the market on Thursday as we saw it pull back. Now, during the week after June options expiration, which is this current week, the Dow has only managed gains in only 2 of the last 22 years after expiration, and has been down 13 straight. So it appears that we will be down this week just like the other weeks for the last 22 years, except for exception of 2 weeks. Now, it's interesting that it looked like we were going to end up with a positive week after options expiration. But notice we said that our goal was to get to this top of this yellow zone, and that's exactly where we got. We got there on Tuesday. We kind of hung out there on Wednesday, giving us a potential reversal sign, and we got confirmation of that reversal sign on Thursday as we got a lower low and a lower high. Now, where are we headed in the market? Well, we're headed into a down cycle with a lower high, lower low, and it'll be interesting to see how the market handles this news that has taken place. After the market closed yesterday, we got news that many of the largest banks had been downgraded, including Bank of America and JP Morgan. So some issues going on out there as the market sorts its way through these problems. Now, for the market to move that far in a day where there's some leaks, did that information get out before the general public got it? And that's probably true, and you might as well get used to it. But it told us what it was doing when we broke through Wednesday's low. So it was obvious what was happening as we see the market had a huge pullback on Thursday. All right, looking at it in a little larger and magnified view, we see that we went up to this predicted. And by the way, isn't it great when the market does exactly what it says, it's what we say it's going to do? And that's exactly what happened. We had talked about this climb up that we expected it to establish the summer trading range, and that's exactly what it did. It came right up to that level, popped above it a little bit, but notice when it closed during the day, it closed right in that yellow zone. Very nice, predictable market as it did that, and we saw that we got confirmation on Thursday as the market pulled down, giving us a lower high and a lower low. We have a real-time indicator. Now almost went down to the 30-day moving average. But remember, there is no great influence from the 30-day moving average on a sideways trend. And we are in a sideways trend. And expectations are that we will probably be headed lower, finding a current low and seeing if we are going to maintain this sideways trend out of the market. Notice that we've got a low here, and that really is our target. There's also a lot of support right through here at 1310. And it looks like this is kind of shaping up. And remember, I'm prognosticating here that this could be our summer trading zone, somewhere between 1360 and 1268. So that would give us really a 100-point range, which would be a large range for the summer. And expectations are that's where we'll probably continue, and we'll continue in with this sideways range as we've had that big change after that big first quarter of 2012. All right, so that's the market as it took place the first 4 days. It'll be interesting to see what it does on Friday as we close for the weekend. Will they want to hold positions through the weekend after this big pullback? All right, so let's take a look at some of the other markets and see if they followed after looking at the S&P. We see the Dow looks very similar, up Monday, Tuesday, Wednesday, continuing with that up cycle as the Dow had no problem going above that 50-day moving average, and then bingo, bango, bongo with the other market, with the S&P. We saw the Dow come down hard and a big pullback of 250 points for the day on Thursday, as the market was responding to both economic news and forecasted news about what was going to happen to the banks. Europe isn't helping any, but we did have a nice little run, which kind of surprised me at the beginning of the week, Monday, Tuesday, and Wednesday. But it looks like we will follow through with history, and we will see a negative week following June expiration. All right, so now let's take a look at the NASDAQ, see how the NASDAQ weathered this type of storm. And we see that the NASDAQ really helped lead this down as it came very close to that 30-day moving average. Again, charts looking similar, a little more emphasis out of the NASDAQ than the Dow or the S&P. As we saw a little bit bigger pullback here, we saw a nice move up, and now we saw a big pullback in the NASDAQ, down 2.44% on Thursday, as we also went into a down cycle in a sideways trending NASDAQ, spending time above the 30-day moving average and below the 30-day moving average. NASDAQ following the overall market, so let's see if the Russell did exactly the same thing. We see the Russell actually made it to the 30-day moving average, approaching the 200-day moving average. And the Russell had been in a more defined sideways trend for a while, as the Russell was spending time above and below the 200-day moving average, definitely showing a great deal of weakness relative to the other two markets, as it had a much bigger pullback than the other two. With that, the VIX really had quite a move for the day, up about 15.5%, and it had just registered a monthly low as we in the VIX as we opened up the market on Thursday morning, and all of a sudden here we are at the extreme of our normal range for the VIX, as it was up 15% for the day. It could have been actually worse, as stocks had these big losses, but that's quite a move out of the VIX in one day. Still trading in that 20 zone, 20 to 14, which are where it spends 85% of its time. Only been there for about 4 days, and we'll see whether it continues to stay there or whether we're going to pop higher on the VIX and put more volatility back in the market. End up with potential head and shoulders there. We'll see what happens with the VIX. We don't interpret technical analysis on the VIX the same as we do many of our other stocks. We're interested in highs and lows and utilize it as a signal when to move in and out of positions when it's at extremes. The bond market did not move all that much, considering how much the weakness we had in stocks on Thursday, with a very small candlestick, relatively speaking, and relatively limited gains. So bond market didn't really believe that this move was as real as one might think, and we didn't see any gaps, we didn't see any moves out of the bonds to the upside, as it many times can be our safe haven when the stock market takes its plunge. Looking next at the financials, let's go see what the financials did as we were facing these rather downgrades on the banks, and we see that the financials followed the overall market. Had been a very nice upcycle leading the market up, which the financials very often do. And as we'll see, if the market does pull back, the financials will most likely help lead it down. As the financials were cooking away, the next thing we're going to take a look at is oil. With the market showing such weakness, one could make some predictions as to where oil is going. But better than that, let's go ahead and look at the chart. And we see that we broke through support on oil, and we continued the plunge in oil as we broke into a new trading zone, headed lower with the oil, as it was down. The USO ETF was down 3.3% for the day, with a breakout to the downside. And so oil continues its plunge. It is strictly in a downtrend. Oil showing a great deal of weakness. And if there is another safe haven, it certainly would be gold. So let's see what gold did on this Thursday in the month of June during the summer doldrums. And we see that gold plunged. There was no move to safety in gold, and gold plunged according to the GLD Spider ETF. And we see that we actually broke through this previous area right in here, and we actually finally filled this gap, which we know most gaps get filled. The market does not like leaving these gaps behind. So gold showed weakness on Thursday, and we'll see what happens as it goes into the weekend. But we've kind of entered into dropped below that 30-day moving average with much gusto. Again, trading in this yellow zone after not spending much time above it. So one might extrapolate that we could see gold pull further if it follows its technical analysis. Gold's one of those things, however, that can move based upon haven for safety. All right, so let's take a look and see what kind of volume we had yesterday, looking at the ETF for the Spider, as we find out whether there was any oomph behind this move. And we see that we had probably a greater than average volume day. Certainly not that kind of a day, but our average volume is probably somewhere around that level. Looks like it was a little above average, as we saw the Spider, the exchange traded fund, which trades the SPX, the S&P 500, and showed us that we had a little bit of an increased volume as the market pulled back with much gusto on news out of Europe, economic news out of the United States, many of it disappointing, some of the weakest since we've seen since way last summer. And so we'll see if this continues in its downtrend, as we have a trading range that is basically from this yellow zone up here which was the bottom of this yellow zone. And so there's our new summer trading range, and we'll see how we trade within that range, and whether they want to hold positions or whether there's going to be a bit more of a sell-off going into the weekend. So with that, for those of you that are not gold members, well, the gold members will be able to stay. We'll be able to look at see how our charts, our horsemen, reacted to this big move in the market on Thursday, as the upcycle in our sideways trend has slowed a bit, and we're redistributing a little bit some of the power within the market, and it's just doing what technical analysis expects it to do. We called this. We talked about it last Sunday. We actually gave everybody a target, so you should have been well armed to take your profits out of your positions. And as we saw that hit that on both Wednesday and Thursday, we had opportunities to go to the short side of the market. And if you did, you certainly got well paid yesterday, as your vertical spreads and your calls or puts, or your puts rather, certainly would come home to roost. For those of you that are gold members, stick around. We're going to take a look at these charts to watch. It certainly has been an interesting topsy-turvy week in the market. We did do what on average the market does on the week after June options expiration, as we saw it pull back, which it has done all but 2 years out of the last 22 years. So for those of you gold members, we'll continue with our list of stocks to watch. For the rest of you, if you would like to see more free videos from Options University, go to www.optionsuniversity.com/free gold. So with that thought, this is Butch Shorak. It's Friday, June 22nd, 2012, looking at a well-deserved weekend, and this is Options University. Thank you for being here.